3.2, we have got two companies here, Flexi Ltd, and the second one is Broom Ltd. Broom Ltd. We have got these two limited liability companies, which is Flexi Ltd and Broom Ltd. The information relates to two companies. There is a background information that we are given here. It says both companies operate in a fashion clothing industry. The financial year ends on the last day of February each year. Both Yates owned shares in both companies. It's Bob Yates owned shares in both companies. On 1 November 2020, he convinced the board of directors of Flex Ltd to repurchase 150,000 of his shares. He used the money received to purchase additional shares in Broom Ltd. Right? Note, where comments or explanations are required, quote financial indicators or figures and trends to support your answer. So 3.2.1. 3.2.1. Right, profitability. We are looking at profitability of these two companies. Remember, Bob Yates owned shares in both companies. And then on the 1st of November 2020, he convinced the board of directors of Flex to repurchase 150,000 of his shares. He used the money received to purchase additional shares in Broom Ltd. Right, profitability. Quote and explain two financial indicators to show which company is managing its expenses more efficiently and is thereby more profitable. So we need to look at the financial indicators of the two companies, and we want to identify the company that is managing its expenses more efficiently. So let us then go to page 9 of the question paper and information B, where there is financial indicators. There is financial indicators, interest rate and market price of the shares. If you look at the percentage operating expenses on sales for both companies, Broom Ltd, the operating expenses on sales decreased from 17% to 13.6%, while Flexi Ltd increased from 14.6% to 17.5%. So in this case, we can see that Broom Ltd is managing operating expenses effectively. And if we look at the operating profit of Broom Ltd improved from 20.5% to 24.2%. And the operating profit on sales for Flex Ltd decreased from 21.9% to 18.2%. So going back to the question it says, explain two financial indicators to show which company is managing its expenses more effectively. So we want one company that is managing its expenses more effectively. And in this case, having looked at the financial indicators for both companies, it is very clear that Broom Ltd is the one. Broom Ltd manages his operating expenses effectively. Let us then quote the percentage operating expenses on sales decreased. The percentage operating expenses on sales decreased from 17% to 13.6%. So the percentage operating expenses on sale decreased from 17%, which then tells us that this company is now managing operating expenses effectively, because you can see that the operating expenses are now decreasing. And even when you look at the percentage operating profit on sales, Percentage operating profit on sales. It has improved. Has improved. Percentage operating profit on sales has improved. It has improved from, let's look at the percentage. The percentage, it is from 20.5% to 24.2%. So Broom Ltd is doing very, very well. The operating expenses are going down and the operating profit is improving. But on the other hand, when you are looking at Flexi Ltd, the operating expenses are increasing and the operating profit are decreasing. So therefore we are saying Broom Ltd is the company that is managing operating expenses effectively. That was 3.2.1 when we were looking at profitability. Then 3.2.2. 3.2.2 has got 3 questions there. Let me number them to say the first one is A. We've got 3 questions there. Comment. Let me check the answer sheet. Let me check the answer sheet here. How did they put the answer sheet? Where I have the answer sheet with me here. Okay, yeah, 3.2.2 has also been separated into 3 questions. So let me just number this first one as my A question. Right, the first one, it says 3.2.2 is based on dividends, earnings and returns. The first one says comment on the dividend payout policy of Flexi Ltd. Comment on the dividend payout policy of Flexi Ltd. Explain why this is an irresponsible change in the policy. Provide 2 points. Explain. Comment on the dividend payout policy of Flexi Ltd. Explain why this is an irresponsible change in the policy. Provide 2 points. So let's look at the dividend payout policy of Flexi Ltd. The dividend payout policy. Right. If you look at Flexi Ltd, their dividend payout rate, the dividend payout rate has increased from 59% to 115%. Dividend payout rate increased from 59% to 115%. The dividend payout rate increased from 59% to 115%. And we are saying that this is a very big change. This is a very big change. So you need to provide 2 points. That's the first point. The dividend payout rate increased from 59% to 115%. Why? The earnings per share, that's the second point. Earnings per share decreased from 138 cents to 80 cents. $1.38 to 80 cents. But increased dividends per share from 82 cents to 92 cents. Not a good decision because the company is now depleting retained income. The company is now depleting retained income. 3.2.2, the question here is saying, comment on the dividend payout policy of Flexi Ltd. Explain why this is an irresponsible change in the policy. Provide 2 points. So we have already provided the answers here. The dividend payout rate increased from 59% to 115%. Earnings per share decreased from 138 cents to 80 cents, but increased dividends per share from 82 cents to 92 cents. So it's not a good decision. You can see that the earnings per share has decreased, but at the same time still the directors have decided to increase dividends from 82 cents to 92 cents. So we are saying this is not a good decision because the company is now depleting the retained income. Because it's clear, if you are paying dividends of 92 cents when the earnings per share for the current year is 80 cents, so it means the 12 cents you are taking from the retained income, the 12 cents more, because 92 cents dividends per share is more than 80 cents, which is our earnings per share. So where are you getting the 12 cents? The 12 cents is obtained from the retained income. So we are saying it's not a good decision because the company is now depleting the retained income. But also some students may argue that this decision is based on the policy that the business wants to please the shareholders and want to encourage more shareholders to come and join the business. But that will also be marked correct. But looking at this decision, it was definitely not a correct decision because it is important that the company needs to retain funds for the future development of the business. The second question, let's mark it B. The second question marked B, it says comment on the percentage return on shareholders' equity of each company. The percentage return on shareholders' equity for each company. So we are now having to quote. Let's start with Flexi Ltd. Flexi Ltd. Flexi Ltd. Roche, which is the percentage return on shareholders' equity. Yes. Comment on the return on shareholders' equity. Yes, that is Roche. Return on shareholders' equity for Flexi Ltd. decreased. Roche decreased from 12.2%. Decreased from 12.2% to 7.6%. 7.6%, which is even less than an alternative investment. We are not happy with this decrease. The percentage return on average shareholders' equity decreased from 12.2%. So the return to shareholders has decreased from 12.2% to 7.6%. And 7.6% is too little. It's even less than an alternative investment. If a shareholder decides to invest his money into a fixed deposit, he will be getting more than this 7.6%. So this 7.6% is not good at all. It's a return that is not good when it is compared to an alternative investment. And let's look at Broom Ltd. And we are looking at the same thing, Roche. the percentage return on average shareholders equity. ROSHE for Broom Ltd, ROSHE for Broom Ltd has increased. Return on shareholders equity has increased from 10.7%. 10.7% to increase from 10.7% to 14.1%, which is good, as it is better than an alternative investment. Yes, the return on shareholders equity should always be compared to alternative investment, and we are very pleased with the results from Broom Ltd that the return on shareholders equity has increased from 10.7% to 14.1%. This is good, as it is better than an alternative investment, of which in this case is a fixed deposit. But for Flexi Ltd, we are very bit worried that 12.2% has decreased to 7.6%, and 7.6% is even less than an alternative investment, and in this case, which is fixed deposit. Right. And then C of the same question, which is 3.2.2. C, a shareholder feels that earnings per share in Broom Ltd are better than that in Flexi Ltd. Explain why you agree. Let's start with Broom Ltd earnings per share. Broom Ltd earnings per share, EPS, are better than Flex. Explain why you agree. If we go and look at the earnings per share of Broom Ltd, the earnings per share of Broom Ltd is 72 cents. 72 cents over, let's look at the net asset value per share of this company. The net asset value per share is 632. We want to calculate the percentage of the earnings per share to NAV so that we compare these two companies. So 72 over 632 multiplied by 100, that is giving us 11.3%. 11.3%. So EPS to NAV equals to 11.3%, which is better when you compare. Let's then compare to Flexi Ltd. Let's compare to Flexi Ltd. Flexi Ltd. Let's look at their EPS. Their earnings per share is 80 cents. Earnings per share is 80 cents over the NAV. 80 cents earnings per share over NAV, net asset value per share of 1,081. 1,081. 80 over 1,081 times 100 equals to 80 over 1,081 times 100 equals to 7.4%. So you can see we can then agree, because here EPS to NAV is 7.4%. So that is why we are saying here, the question, if you look at the question says, as a shareholder feels that earnings per share in Broom Ltd are better than that of Flex, explain why you agree. If you look at the earnings per share of both companies, Broom Ltd, it is 72 cents per share, but Flexi Ltd, it's 80 cents per share. But if you are then comparing it to their NAV and even the market price, you can then see that in actual fact, Broom Ltd is better than Flexi Ltd, because the EPS to NAV for Broom Ltd is 11.3%, and the EPS to NAV for Flexi Ltd is 7.4%. You can even check the EPS to market price. EPS to market price for, in the same question, for Broom Ltd, the EPS to market price. You can even check EPS to market price for Broom Ltd. So let us check EPS to market price for Broom Ltd. Yeah, EPS to market price. Even if you want to check it through EPS to market price. EPS to market price, let's do some calculations for Broom Ltd. For Broom Ltd, you have 72 cents over 660. 72 cents over 660 times 100 is 10.9%. EPS to market price is 10.9%. EPS to market price. And Flexi Ltd, EPS, earnings per share to market price, is earnings per share to market price is, let's then calculate it. You have EPS of 80 cents, 80 over the market price of 990, 80 over 990 times 100. The EPS to market price is 8% here. So this is what we are saying. Go Broom Ltd. Broom Ltd is better than Flexi Ltd. If you look at their EPS to NAV, it's better than Flexi because it is 11.3%, while Flexi it is 7.4%. Even when you check their EPS as compared to a market price, what percentage is it to the market price? EPS to the market price, it is 10.9%, which is better than Flexi Ltd because EPS to the market price in this case is 8% for Flexi Ltd. So we do agree with the question, because the question was saying, as a shareholder feels that earnings per share in Broom Ltd are better than that in Flex. Explain why you agree. So we have agreed by providing calculations. These are the calculations that have been provided to prove that it is better. 3.2.3. 3.2.3. Shareholding of Bob Yates in board companies. Comment on the price paid for the shares repurchased by Flexi Ltd. Provide 2 points. Comment on the price paid. Right, Flexi Ltd, the repurchase price is 13 Rand 20. Repurchase price is 13 Rand 20. A repurchase price is 13 Rand 20, and we want to comment on this price. This price, we can be able to comment on it having to look at the NAV, with how much is the value of our shares and how much are they sold for in the market. So the repurchase price is 13 Rand 20, while the net asset value per share for Flexi Ltd, the net asset value per share is 10 Rand 81. 10 Rand 81. The price is more than 13 Rand 20 is more than the NAV, the net asset value per share of 10 Rand 81, and even the market price. The market price, how much is the market price? The market price is 9 Rand 90. So we are saying that 13 Rand 20 is not a fair price, not a fair price, not a fair price, as it is more than the value, which is NAV, and the market price. So this price that this shareholder charged us, which is 13 Rand 20, is not a fair price. So 13 Rand 20 is not a fair price because the company has paid 13 Rand 20, which is more than the net asset value per share of 10 Rand 81 cents. And this price is even more than the market price. If you can buy these shares in the market, we can only pay 9 Rand 90. But we have paid 13 Rand 20 for these shares. So we are not happy. If we have to comment about this price, we are not happy with the price. So this is our A question. Let us then go to our B question. B question. Calculate the number of shares that Bob purchased in Broom Ltd with the money he received from the share buyback at Flexi Ltd for 2 marks. Calculate the number of shares Bob purchased at Broom Ltd with the money he received from the share buyback at Flexi Ltd. Okay, so let us then look at the number of shares. Funds used to repurchase shares is 1,980,000. The repurchase price is 13 Rand 20. Increase in share capital, it is 2,640,000. Issue price of additional shares, it is 6 Rand 60. So let us calculate the number. Increase in the share capital is 2,640,000. And then the issue price of the additional shares, it is 6 Rand 60. And remember, in the beginning, there is a statement here in the beginning which says Bob Yates owns shares in both companies. On 1 November 2020, he convinced the board of directors of Flex Ltd to repurchase 150,000 of his shares. He used the money received to purchase additional shares in Broom Ltd. So the money that he received out of the repurchase of shares is 1,980,000. The money that he received, it's 1,980,000. The money he received, funds used to repurchase, was 1,980,000. And the issue price of the additional shares from Broom Ltd is 6 Rand 60. It is 6 Rand 60. So 1,980,000 divided by 9 Rands. We want to calculate the number of shares that he purchased. 1,980,000 divided by 6 Rand 60. That is 300,000 shares. This person purchased 300,000 shares. 300, we have the answer. Funds used to repurchase shares is 1,980,000, and then the issue price of additional shares is 6 Rand 60. So then 1,980,000 divided by 6 Rand 60 is giving us 300,000 shares. Okay, let us then go to shareholding of Bob Yates in both companies. That is information C. Shares in each company. Flexi Ltd 2020, it was 433,500, but 2020-21 it is 283,500. Broom Ltd 2020, it was 460,000, 41.8%, and then 2021 it is not given. And then 3.2.3 it says explain the effect of the share repurchased on the percentage shareholding of Bob Yates in each company. Explain the effect of the share repurchase on the percentage shareholding of Bob Yates in each company. So if we look at Flexi Ltd, that is C, Flexi Ltd, the percentage shareholding was 51%. 433,500, it was 51%. And now 2021, shares in each company, he owns 283,500. And the number of shares in issue for Flexi Ltd is 700,000. So we can be able to calculate the percentage that we have 283,500 over the total number of shares in issue, which is 700,000 for Flexi Ltd, which is 700,000 multiplied by 100. 283,500 over 700,000 multiplied by 100. Let's get the percentage here. 283,500 divided by 40.5. 283,500 shares divided by the number of shares in issue, which is 700,000. Multiplied by 100. 40.5%. Percentage shareholding decreased from, it was 51%, from 51% to 40.5%. Lost the majority shareholding status. Right. If we are looking at Bob Yates, the percentage shareholding, because 3.2.3 is asking us to explain the effect of the share repurchase on the percentage shareholding of Bob Yates in each company for 4 marks. So if we are looking at the percentage shareholding for Flexi Ltd, if you look at the number of shares that he owns now is 283,500 out of the total number of shares, which is 700,000. So 283,500 over 700,000 times 100. So the percentage shareholding is 40.5%. So we are saying that the percentage shareholding decreased from 51% in 2020 to 40.5%. 51%, this person was a majority shareholder here. He was a majority shareholder in this company, but because of the shares repurchased, then the percentage shareholding went down to 40.5%, and therefore he lost the status. He lost the majority shareholder status from Flexi Ltd. But let us then check with Broom Ltd. Let's check with Broom Ltd as to what happened. Let me just wrap here. Create a new space. We are still discussing question 3.2.3. 3.2.3, and we are C. Still C. And then now we want to look at the percentage shareholding now in Broom Ltd. Broom Ltd. As to what happened with Broom Ltd. Broom Ltd, this person had 460,000 shares. 460,000 shares, and he purchased an additional of 300,000 shares. 300,000 shares plus 300,000 shares plus 300,000 shares, which now gives us a total of 760,000 over 760,000 shares over the total number of shares in issue for Broom Ltd, which is 1,500,000. 1,500,000 shares multiplied by 100. So let us then check the percentage shareholding for Broom Ltd. 760,000 divided by 1,500,000 multiplied by 100 equals to, it's 760,000, my zeros, divided by 1,500,000, 500,000 multiplied by 100. 50.6%. That's equal to 50.6%. 50.6%, which is, if you can round it off, you can put it 51%. It's 50.6%. So his percentage shareholding with Broom Ltd, percentage shareholding increased from 41.8% to 50.6%. to 50.6%. And then this person may now be regarded as a majority shareholder here. So he lost the status of a majority shareholder from Flexi Ltd, and this shareholder is now with Broom Ltd, and he has gained the majority status from the new company. So he lost the status in that one and gained the new status here, which is the majority shareholder, because he moved from 41.8% to 50.6%. So that is the effect. We have explained the effect of the shares repurchase on the percentage shareholding of Bob Yates in each company. 3.2.4, which is the last question. In this question, it is 3.2.4. 3.2.4. Financial strategies and gearing. The directors of each company have taken deliberate decisions that they are reflected in the cash flow statement. Explain the decisions. Explain the decisions taken by the directors of Broom Ltd and how will this benefit the company. Okay, all right. Financial strategies. Let's repeat the question. Financing strategies and gearing. The directors of each company have taken deliberate decisions that are reflected in their cash flow statement. Explain the decision taken by the directors of Broom Ltd and how these will benefit the company. So let's look at the decisions that were taken by Broom Ltd. And also the second one, explain how the decisions taken by Flexi Ltd affected the risk and gearing of business. Quote 2 financial indicators. Let's start with Broom Ltd, the decisions that were taken. If we look at Broom Ltd, what is it that they have done? There is a fixed asset purchased. There is a fixed asset purchased of 2 million. Fixed assets purchased of 2,200,000. And with Flexi Ltd again, there is another fixed asset purchased of 1 million. Broom Ltd, they increase. There was an increase or decrease in loan, and this was 400,000. So let's start with, we are focusing on Broom. Broom Ltd, they increase a loan. Oh, it's an outflow. The first decision by Broom Ltd, if you look at the figures there, they increase the loan or decrease the loan. Broom Ltd, they repaid the loan. They repaid the loan for how much? For 400,000. They repaid the loan for 400,000. So this repayment of loan of 400,000, how will this benefit the company? It will benefit the company because the company will save on interest on loan. And another decision that they have also taken with Broom Ltd was to increase the share capital. Increase the share capital by 2,640,000. They have increased the share capital by 2,640,000, which will then make the company to have more funds available for the operation of the business. They have also purchased a fixed asset purchase that was an inflow of cash, but they have increased the share capital by 2,640,000. And then let's look at the decisions by Flexi Ltd affected the risk and gearing of the business. Quote 2 financial indicators. Let's look at the decision by Flexi Ltd. Flexi Ltd increase the loan. They increase the loan. $4,500,000. And how has this affected gearing? How is this? Quote 2 financial indications. So let's look at the gearing. Let's start with the percentage return on capital employed. Percentage return on capital employed decreased from 16.1. ROTCE decreased from 16.1% to 10.2%. The ROTCE decreased from 16.1% to 10.2%. That's the return on total capital employed. And then if you look at it, debt equity ratio increased from 0.4 is to 1 to 1.1 is to 1. So high risk, this is high risk. This is high risk. The debt equity ratio is increased from 0.4 is to 1 and it is now to 1.1 is to 1. So the business is now at high risk. The loans are now too high. And if you're looking at the return of 10.2%, the return of 10.2% is less than the interest rate on loan. ROTCE 10.2%, less than interest on loans, which is interest on loans is 13%. And therefore we are saying there is a negative gearing. So coming back to this question of Flex Ltd, explain how the decision taken by Flex Ltd affected risk and gearing of the business. Code 2 financial indicators. The risk, if we start with risk, the risk is now too high. Its debt equity ratio has increased from 0.4 is to 1 to 1.1 is to 1. And the gearing of the company, the ROTCE, is the return on total capital employed is 10.2%. What we are getting from this money is only 10.2% when we are expected to pay interest on loan at 13%. So the interest on loan of 13% is more than the return. So we are saying now the company has got a negative gearing. So I think this decision of increasing the loan this much was not a good decision, considering that even the return is not good, the risk is now too high, and the gearing is now negative. So this question brings us to the end of question 3, which was based on the interpretation of financial statements. So it's very important that people should be able to interpret profitability ratios. That was 3.2.1, 3.2.2 dividends, earnings and returns. You should be able to understand profitability ratios. There you need to make sure that the company is making profit. So the percentage operating profit should always go down. It should always decrease the percentage operating expenses when it is compared to sales. Like in this company, the percentage operating expenses on sales decreased. So if the percentage operating expenses on sales is decreasing and the percentage operating profit on sales is improving, so we are saying that the profitability is good in that particular company. Like in this case, we prefer to Broom Ltd because their operating expenses decreased from 17% to 13.6, but the operating profit increased from 20.5 to 24.2. Then with the dividends, earnings and return, we are saying the payout rate, the percentage, the payout rate, it should not be unreasonable, because we need to consider the earnings per share. When the dividend per share is more than the earnings per share, it's indicating that now we are taking funds from the retained income account, and the retained income account, we are keeping that money for future development of the business. So we need to notice that if the dividends per share is more than the earnings per share, it means we are using all the money that we have earned, and we are also even taking from the retained income account. So that was basically dividends. The percentage shareholding, we have noticed that Bates lost the majority shareholder status in Flexi Ltd, but with the new purchase from Broom Ltd, he has also increased from 41.8% to 50.6%. We also look at the decisions that were taken by Broom Ltd. The first one was repaying the loan of 400,000. They will save on interest. They also increased share capital by 2,640,000, and therefore the company will have enough money available for the operating of the business. Flexi Ltd, they increased loan by 4,500,000, and this decision, we are saying it was not a good decision, considering that it has led to an increase in the debt equity ratio, and we are now at high risk, 0.4:1 to 1.1:1. The return on total capital employed is 10.2%, is even less than the interest on loans, so there is negative gearing. So we are not in favor of this decision of increasing this loan by 4,500,000. So this is bringing us to an end of question 3.